This is Daybreak Asia. We're counting down to Asia's major market opens, and Haidi, at the start of the day here, we're just really quite closely tracking what's happening with the Japanese yen, because we are just seeing it moving off the back of those summary of opinions from the April meeting. And certainly it does seem like perhaps there's a need to discuss further rate hikes to come.
Yeah, and it's interesting. They're talking about specifically the impact of the yen, right? Saying that potentially these moves in the yen, the impact on the trend may speed up the process of normalization. But on the other hand, that weakness across the consumer spending side, domestic households, as we see that weakness of the yen is really one of the key points when it comes to how quickly they move as well. And Belle, to that point, we also had some perhaps concerning weakness still when it comes to wage gains.
Yeah, that's right. So we saw real wages down 2.5% from a year earlier in March, and that was actually the steepest drop, or the deepest drop, that we've seen in 4 months. And the running streak of declines now at 24 months. So certainly that has been the real question for Japanese government officials. Would they start to see inflation being driven by the demand side, or would it still be from the supply side instead? But this is certainly perhaps some numbers that the BOJ would not want to see at this point in time. But as we said, that focus as well off the back of those wage numbers coming into those BOJ summary of opinions, and lots of different lines dropping out of this. But as we said, this need perhaps to raise rates appropriately at the right time, and also the need to deepen talks on rate hike timing. So just some of the headlines that are dropping from that. Also, they're saying it's vital to cut bond buying by looking at demand and also supply dynamics. But here you've got that market reaction so far. Just a slight bit of strength coming back into the Japanese yen here off the back of it. Nikkei 225, again, we're online this morning. A little bit of upside, but fairly range-bound in the session as well. And one of the key commentaries that we're really getting from Wall Street trading in particular is that just given that the Fed not really doing anything until September at the earliest, we've got earnings, a lot of those are in the rear view mirror at this point in time. It's really that search for the next catalyst for market direction. Let's shift on now and take a look at the outlook for Korea, because as well, Korean equities just starting to trade here. Again, a little bit to the downside, but very much range bound as well. What we're also well tracking is that eco data here this morning, and it's that focus on the current account numbers. We saw the surplus widening to $6.93 billion over the March period. So something as well that can have an impact on the Korean currency. Haidi.
Yeah, take a look at how we're opening here in Sydney as we get sort of that staggered session coming online there. We did see Australian stocks in the previous session posting that 5-day winning streak. Could we sort of extend that into a 6th straight session of advances? This is the longest winning streak since late January. We have seen kind of that rally in recent days over optimism over the bank share buybacks and the outlook for RBA policy. When it comes to the banks, we had a similar picture coming from CBA, but of course, when it comes to the trading update, we haven't heard that similar return to shareholder value sort of story, but that doesn't mean that's sort of entirely ruled out for CBA either. So that's a stock to watch as we get into the start of trading. Interestingly, Citi is saying now is the time to sell Australian bank shares and to buy miners on the dips, according to that usual May to October slump that we see in mining stocks. Citi sees that as an opportunity to rotate into the sector and away from the strong performing banks. So that's one to watch in the day session. We're also watching in terms of themes, Australia backing a $47 billion gas sector transition role. So watching for some of those nat gas names potentially seeing a reaction today as well. Aussie dollar sitting at 65.74 there. We had, of course, so much focus when it comes to the yen, but that dollar focus has really been a little bit higher given the string of Fed speak that we've had this week as well. Taking a look at how bonds are trading, we're seeing Asian bonds falling early on Thursday, really echoing the selling pressure that we saw across treasuries in the prior session, supporting the dollar there, of course, and you're starting to see, you're still seeing that picture across trading and treasuries at the moment, Belle.
Yeah, and Haidi, perhaps difficult to get a sense of where we go from here until we get the US inflation print numbers next week as well. And that's certainly going to play into the dynamics for the Japanese yen, as we're saying that strengthening a little bit following the summary of opinions, and also something that has ramifications for Japanese stocks that have been sliding of late. But let's bring in our next guest who suggests buying Japanese equities on the dip. With us now is Julia Wang, Executive Director and Global Market Strategist at JP Morgan Private Bank. And Julia, yeah, we had that impressive run-up in Japanese equities. It pulled back slightly. Is this an opportunity, do you think, to get in?
Yeah, definitely. Thanks for having me on the show. So, yeah, if we take a step back, we had a really good Q1. And I think that since mid-March, we saw Japanese equities starting to correct due to two factors. One is the global pullback in AI and semi-related names after a very strong run. And secondly, as you mentioned, some volatility causing investor concern around the yen. Now, we do think that if you take a step back and think about our broader thesis for Japanese equities, it's really predicated on structural changes happening in Japan's market. The first one is that if you believe that AI is arriving and it's going to transform the global economy and result in greater demand for semiconductors, for example, then Japanese companies are indispensable on the semiconductor supply chain. They're going to be in a leading position to benefit. And of course, add to the top of that, the global supply chain shift. So that is really the core thesis, and I think that's why you're seeing Japan's economic recovery is really the corporate sector, corporate investment that's driving the recovery at this point in time.
I've got a question on the AI rally as well, because we're just tracking shares of SoftBank, for instance, this morning, heavily exposed to ARM holdings. And overnight we had that big drop in ARM after it gave pretty weak guidance.
Yeah.
So there are those concerns that are building around spending on AI in particular. Do you see that sort of also becoming a bit of a theme, though, and potentially negatively impacting Japanese equities if they're very exposed to this trend?
Well, we think that obviously the leading beneficiaries, the first, the most innovative companies, there's been a lot of very high expectations going into the earnings. So we don't think necessarily the earnings season as a whole indicate any real weakening in the demand for AI as a structural thing. But having said that, market has already I think being quite optimistic for many of these companies going into the earnings season. So that's why I think we had those pullback in the U.S. market as well as the Japanese market. But our broader thesis is really that if you look at the global economy in the next 4 to 5 years, many of your equipment, many of your daily appliances will have a bigger AI component to it. And it's really the broadening out of the AI application that benefits your things like your smartphones and your tablets. And this is where Japan's industries are very well positioned because they are virtual monopolies in many of these equipments or materials. So that's very hard to replace. So we talk about Japanese yen being possibly a tailwind, a boost. But even without a further weakening of the yen, these companies are already very competitive and it's hard to replace them. So I think that is the thesis of why we like Japan on the structural side. And of course, there's a reflation story. And I think that investors do have to be aware that Japan was in deflation for 30 years. So consumers have a propensity to not spend. But as we're starting to see cumulative wage gains really changing expectation for Japanese household, and these show up in all Japanese sort of expectation surveys. So what that means is that, we know that corporate profits has been hitting all-time highs for the last couple of years. So there's a foundation for sustained wage growth going forward. So the reflation story, we think, is still in play. It's just not, it's going to take a bit more time, I think, because of, how much for how long the Japan economy was in deflation. And of course, there's corporate reform, the prospect of greater shareholder return and value creation. So these are the structural themes that we like, the reasons we like Japanese market, and that's why we think that the recent dip, the correction, is actually a great opportunity for investors to re-engage with this market.
And Japan has obviously benefited from some of those initial flows away from China, for example. Do you think this is the right time to re-engage with China? Do you think this is the real deal when it comes to the rebound that we've seen?
So I think that the China market rebound, recovery over the last 2 months were driven by several factors. First factor is the diversification away from U.S. and Japan to some degree after a very strong run in the first quarter. As its rebalancing flow look for places to go, they look at the China market. And what we have seen at the same time is the economy continue to hold up, even as we debate about the underlying challenges and how sustainable they are. The fact is that the economy held up. So, looks like policymakers can stay the course. And lastly, valuation was very undemanding in the China market after a sell-off in January. So all of these three factors, we think, in combination, mean that investors may have reassessed a little bit just how much to allocate to China and Hong Kong. And that's why we had a recovery in these two markets. But if you think about, on the other hand,
Oh, no, finish your thought.
Yeah, of course. So as we think about the underlying economy and the policy outlook, this haven't really changed. So we do think that the market rally has been very strong, of nearly over 20%. And by going forward, you do have uncertainties on the horizon as well, be it geopolitical, policy constraints, the housing market. So these are all the reasons why I think tactically would prefer to take some profit at this point.
Yeah, Julia, I was going to ask you, what's your strategy across credit right now?
So we are still quite up in quality overall in credit. I think that obviously high yield market has had great returns this year, but we continue to think that the overall macro backdrop for the global economy is one of slowing. I know we're seeing contradictory data here and there, but rates are restrictive. We are seeing the service sector slowing both in the U.S. as well as the Eurozone to some degree. So we do think that global demand is slowing. And I think against that backdrop, we do think that the credit cycle will start to have more stress. So we prefer to lean up in quality still in credit.
Julia, always great to have you with us. Julia Wang, Global Market Strategist at JP Morgan Private Banker. Let's take a look at SoftBank and some of these other adjacent chip stocks after really the disappointment when it comes to ARM. We saw ARM shares falling after the company gave a pretty tepid annual forecast there. They're down about 8% in extended trading. They gave that full-year forecast that's really been seen as mixed relative consensus, particularly in light of pretty high expectations there. And Bloomberg Intelligence saying that it was a beat on fiscal for first quarter of outlook, but all of that is kind of getting overshadowed by the narrow miss on 2025 sales guidance. So some of that enthusiasm being curbed there. You're seeing the downside reaction in SoftBank, of course, as well as the likes of Tokyo Electron. We're seeing Hynix probably the best performing, if you will, out of that cohort there. Morgan Stanley saying that they actually expect ARM to continue outperforming expectations through next year, given a broad range of drivers, Belle.
Yeah, and Heidi, still ahead, President Biden threatening to hold back further arms shipments to Israel as US unease grows over civilian casualties in Gaza. We'll have an update next. This is Bloomberg.
President Biden says he will halt additional shipments of offensive weapons to Israel if it goes ahead with the ground invasion of Rafah. He told CNN that the potential loss of civilian life is, quote, just wrong.
I made it clear that if they go into Rafah, they haven't gone into Rafah yet. If they go into Rafah, I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks like came out of the Middle East recently.
Bloomberg editor Michael Heath joins us now for more. So, were you surprised, I guess, by this line that's being drawn?
Yeah, I was a bit, Heidi. I mean, it's a shot across the bows to Israel, but it's sort of a decision that will please no one, because I think in a way that the people who are protesting, who want this war to end and think Israel's been totally over the top, you know, there's been accusations even of genocide. Stopping 3,500 bombs isn't going to do that, and this is from a past outlay. It doesn't relate to what was just passed, legislated recently, passed by Congress to go to Israel. So it's not going to do a heck of a lot. But it is. I guess it's. Biden is a long-term supporter from Israel, and as he said there, you know, he'll make sure that their defence is fine, etc. But they've been saying this to Israel for weeks, if not months, that you know, they've got to have a plan to deal with the civilians there. And the US assessment is that it's not going to be possible to do that. So they've got to at least signal intent. But it's just the repercussions that it has. I mean, if you're Hamas, do you sign a deal now when the world's superpower basically is telling Israel we're not going to back you in going in here that, you know, Hamas can live to fight another day. If you're Iran, are you emboldened, or Hezbollah, are you emboldened that perhaps the US is stepping back? Even though it's probably not, that would be their assessment too. So in a sense, it was a surprising decision, but I think they just feel like with Netanyahu, with this very right-wing government, that words aren't enough. They've got to actually take some sort of action. But I think everybody suspects that Biden's never going to leave Israel in the lurch. If push comes to shove, they'll support them as they need it.
And Mike, we've already seen other arms suppliers like Italy, like Spain, like Canada halting sales. But this is, of course, a lot more significant given that 70% of Israeli military aid comes or imports come from the US. Is there a way for them to be able to plug this gap elsewhere?
Yeah, there's a good story. It's a good point, Annabelle, and there's a good story on Bloomberg as well, just looking at this exact issue, that the Israelis are very keen to do that. Now, since the time of Prime Minister Rabin, Israel has basically decided to buy all those sort of ubiquitous munitions off the shelf. It has a very good high-tech industry. It concentrates on building the sort of armaments that you can't get anywhere. So the plan is there that they do want to manufacture their own weapons again here to do that. And I'm sure they have the technological skill to be able to do that. But it's not going to be a short-term fix. We're talking a couple of years away. And the issue, I guess, then just comes down to what sort of stockpiles do they have. You suspect that Israel's going to be able to if they do really want to go into Rafah, they'll find the way to do it. But the US it has to join those other countries. It feels like it's got to take some sort of stand here. But I think that Israel just has the means that if it does want to take Rafah, it'll find the weapons, the munitions that it needs.
We've got another really interesting story talking about how Beijing and also Russia, to an extent, are trying to take advantage of the global discontent, right? The increasing criticism. Is this sort of an effort to try and criticise the US and, I guess, cleave some support from the so-called global South partners and countries? Yeah,
it's a good story. It's a free hit for China in a way, isn't it? Because you turn on your television, you see these scenes of suffering, and particularly in the global south, where there's probably a lot of resentment with the US, dating back to the Cold War as well. And to have China come in and make that criticism, and I think the UN spokesman talked about the US pouring weapons into a humanitarian tragedy. There's an element of truth in that as well. So they're on a little bit of a winner there, and China does have it really can extend its influence, because as we see with Hungary, what's going on there, they can offer economic assistance to these countries or investment or that sort of stuff. With Russia, it's just pot shots. Russia's got nothing to offer anybody outside of Soviet-dated weapons. It's embroiled in its own invasion with a smaller country. I'm not sure that what people would cleave towards Russia on. But with China, definitely. And China doesn't have a history of being involved in all this sort of stuff that the US does from the 20th century. So it is a free hit. Now, the US pushes back and says China makes, all this sort of criticism. What does it actually do in terms of trying to secure peace? And that's a good point as well. It actually has Russia's ear. It could be a lot more influential over Russia in terms of Ukraine. I mean, it's a massive trading partner with Russia now. It doesn't do anything there. With the Middle East, what does it do? There's very, very little action seen. So it's a lot of talk. But nonetheless, I think the gravitation of the global South, as it's often called, towards China, it's something the US needs to be very wary about, for sure.
That was our editor, Michael Heath, there, and we're, of course, seeing China building its influences in Eastern Europe. And President Xi Jinping has actually arrived in Hungary for the last stop on his trip to the continent, where he's expected to sign more than a dozen agreements with the Beijing-friendly government. Our Asia government and economy correspondent Rebecca Chung-Wilkins joins us this morning for more. And Rebecca, yeah, we've seen it already in Serbia. That's another government that's also friendly toward Beijing. But what are we really expecting out of this, given that the relations between Hungary and China are already fairly well established?
Yes. I mean, in a way, this is the opportunity for China to showcase the advantages of this sort of deep economic relationship with China. But the other element here is the geopolitical commonality between Hungary and China. Hungary is another country that has offered deep support to Russia, that is often very distrustful of the US, is a big proponent of that China-Russia proposal of the so-called multipolar world opposing the US. So there's a lot of sort of geopolitical common ground here that both countries will be able to lift off. But the focus is going to be a lot on the economics. I think at at last count, at least 16 agreements between the two countries. Possibly we see more. We also had this sort of quite full-throated op-ed from Xi Jinping in one of the Hungarian ruling party's main newspapers, sort of, advocating for excellent ties, saying that this is an example in some ways for the rest of China and Europe. And there are a couple of big projects that we know are already under the way. So we have that cattle factory, CATL. That's expected to create about 9,000 jobs. We also have BYD opening its first factory in Europe. It's going to be in Hungary. We know that was a project that, for example, France and Germany were also vying for. So this is also a way in which potentially China can try and ease some of those concerns that are being sort of articulated out of the EU over capacity by actually setting up and moving onshore their factories, their productions when it comes to some of these areas of clean tech, creating local jobs, helping that local economy, perhaps as a way to actually sort of drive a wedge between EU as a whole and the member nations that are benefiting in major ways from this sort of more deeper engagement with China. And Hungary is really important from a strategic point of view for China when it comes to the EU, because Hungary has this ability to obstruct, delay, or sort of, be influential in terms of direction of travel for EU policy. And it also, of course, gives China one route into that single market. So it's hard to overstate the significance for China when it comes to the role that it believes Hungary will play in the EU.
The issue of overcapacity, we knew that was going to be front and centre. Ursula von der Leyen made it very clear what certainly, the European Union is expecting. Is there a quick fix here? Is there willingness, is there ability for Beijing to do anything at this point, given the structural, fundamental vulnerabilities of its own economy?
The short answer is no. There is no quick fix really here. And in partly because a lot of these issues have been underway for, if not years, decades, actually. Overcapacity or some risk of oversupply has sort of characterized the Chinese economy, if you look at property or other forms of sort of manufacturing capacity, in one way or another for a very long time. We did have those, as you say, those comments from Ursula von der Leyen saying that EU is preparing to deploy all tools available to defend its economies. But, I think it's worth waiting to see really whether or not this trip, whether or not the sort of relationships with Hungary and so on, are able to slow the momentum of that litany of probes that we saw. It's not just one or two, but it's quite a few that are currently in the works. But as you say, no real quick fix here. It's really about Beijing, first and foremost, trying to slow the momentum a little bit, trying to sort of get across this message that there is, from their point of view, no overcapacity problem when it comes to China at all, that they're helping, in fact, to ease inflation with these exports. And as you say, it's a central part of how Beijing is thinking about reshaping its economic model of growth going forward. These so-called new three drivers of growth, solar panels, batteries, and EVs are all part of getting that strategy underway. And if they do see sort of significant trade tensions, significant more increases in tariffs or other kinds of friction, that does have a potential to significantly impede that transformation.
All right, that was our Asia government and economy correspondent, Rebecca Chung-Wilkins there. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybreak on their terminals. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. This is Bloomberg.
Take a look at how Commonwealth Bank shares are performing at the moment. We're just about 26 minutes into the start of trading. A little bit of downside, over 1% lower. That buyback, of course, was in focus. That didn't come through. But really, we have seen this broader trend of returning wealth to shareholders in this round of banking numbers. This trading update really is seeing that we've seen sort of a weakness, in fact, a second consecutive drop there. But still, we're also seeing, Bell, perhaps the impact of Citi recommending that rotation from high-flying banking shares in Australia to miners.
Yeah, that's right, Heidi. And also another stock we're tracking this morning is Mitsubishi Motors here. You can see that drop of nearly 6%. The company says its US unit has received a court order to pay more than $1 billion in damages. This in relation to a car accident that occurred in 2017. Mitsubishi is saying it will appeal that ruling by a Philadelphia court. Taking a look at some chip stocks or ARM-related stocks in trading so far this morning. You've seen that drop for ARM and after hours, but SoftBank, of course, heavily exposed to that, declining 2% at this time. Other chip stocks a little bit under pressure for the most part here this morning, and we're seeing the broader tech gauge as well, one of the drags for the MXAP index at this point in time. ARM, of course, we did see the chip designer giving a lukewarm revenue forecast for the fiscal year, but let's get more on that now and bring in our Bloomberg Intelligence senior semiconductor analyst, Kunjan Sabani. And Kunjan, so revenue could be at $3.8 to $4.1 billion. Analysts had been predicting a total of just over $4 billion. We're seeing quite a big drop, though, in after-hours trading.
Yeah, I mean, look, the reported quarter and the guide were pretty solid and strong. We think the long-term sort of AI story and the fundamental drivers remain intact. The driver for the slight miss in the fiscal year guidance was coming really from two major areas. One is networking, and the other is the industrial IoT, which most of the semiconductor companies exposed to this are seeing weakness here. So that's not company specific. It's just that end market is going through a cyclical bottom. There's higher inventories and the demand is weak. So that's what sort of caused the shortfall versus what consensus had. But the drop sort of you're seeing in the stock, the reaction is driven. We have seen that for a couple of other AI exposed names this earnings. One example would be AMD, where investors have these really lofty and ambitious expectations that these names sort of have to come and beat and raise their total revenue and EPS growth numbers above street. So which didn't end up happening, hence what you're seeing in the stock price reaction.
Yeah, Kunjan, because that's right. I mean, it was just a slight miss here on the forecast, but it's quite a steep drop here, nearly 10% at this point in time. So is it the case, yes, that the expectations are just too high from Wall Street, or is there a real concern here that AI spending, that spree could be slowing?
I think it's the first. I mean, look, we didn't see any data points for ARM-specific AI revenue projections. In fact, they actually gave outlook for fiscal 26 and fiscal 27 for growth above 20%. The street averaged slightly below 20% there. So that was, according to us, a pretty robust sign that they have strong visibility into almost 2 years out roadmap, which is mostly driven by their new design engagements coming from AI and their higher V9 architecture and subsystem. So again, there was no sort of weakness in the AI story per se, but overall, just the Wall Street and investors have been just set up this expectation that you just have to come in every quarter and beat your own sort of already high ambitious projections.
Kunjan, we're also seeing weakness when it comes to trading in Intel, right? That's about almost a year low for trading in Intel's share price. The expectation that revenue will fall below that midpoint of $12.5 to $13.5 billion. How much of this is on, again, the announcement of the revoking of licenses from China, the Huawei issues there?
Yeah, well, most of it is from that Huawei restriction. They issued a press release after the news broke out. But again, in a bigger picture, look, we expect this to be a few $100 million of impact, which will impact the next quarter guide, as they've said. But however, we think, for the rest of the year, this sort of what they could have shipped here could have been picked up with other customers. So we don't see that as a significant impact when we look at the fiscal year numbers and going forward. Other than Intel, there was also talk about Qualcomm. Qualcomm, however, even before this restriction, was the revenues that they're collecting from Huawei, which is purely on 4G products, would have as such fallen off after this year. So we don't see this really a material impact to either of these names on the long term.
But does it complicate, do you think, Intel's turnaround plan at all?
Not really. Like I said, the product. Look, when you look at the amount of laptops or desktops that Huawei was using Intel chips in and shipping, and when you think about it, it's less than low single digits in terms of the total market. So it really doesn't move the needle that much for Intel's turnaround plan.
Bloomberg Intelligence senior semiconductor analyst Kunjan Subani there. Sticking with tech, and official Chinese data suggests Apple's iPhone sales, they jumped about 12% in March. It is an early sign of success in efforts to turn around the decline after Apple and its retailers cut prices. The tech giant last week surprised investors by reporting quarterly revenue from China that beat expectations. You can get more on the latest when it comes to Apple in today's Big Take. It's focusing on who might potentially succeed Tim Cook as CEO. Bloomberg's Mark Gurman takes a look at some of the names that are emerging as potential successors. You can get that story on the terminal right now. It's also online at Bloomberg.com and Business Week.
And some of the other corporate stories we're following this morning, and Shopify shares tumbled after the Canadian e-commerce company pledged to continue investing in marketing despite the pinch in profits. The firm sees gross margins in the current period narrowing, a forecast which overshadowed its strong first quarter performance. Its US traded shares saw their biggest intraday decline ever, reflecting concerns about future profit margins. Airbnb is providing lackluster guidance for a second consecutive quarter, suggesting growth in travel spending will slow further before the peak summer season kicks in. It sees revenue for the current quarter between $2.6 to $2.7 billion. Airbnb is blaming the earlier timing of the 2024 Easter holiday, as well as currency headwinds. Nomura has joined JP Morgan in limiting dealings with Asian hedge fund giant Sganty, which is facing charges in Hong Kong of insider trading. Sources say Nomura won't add more leverage or new positions to its dealings with Sganty. The fund, its founder Simon Sadler, and a former dealer says they will vigorously defend themselves against the charges. Chinese developer Country Garden is said to be seeking help from a state-backed program to pay interest due on Thursday. Sources say it's in talks with China Bond Insurance Company over two notes with coupon payments worth more than $9 million. It's the first major test of a program introduced in 2022 to help developers facing liquidity crunches. And we'll have more ahead on Daybreak Australia, or Asia rather, including on that Country Garden story. This is Bloomberg.
China's April trade numbers are due today, and Bloomberg Intelligence expects exports and imports to swing back to year-on-year increases. That's largely, though, due to last year's low base for comparison. Let's get a preview with Michelle Lam, Greater China economist at Societe Generale. So, Michelle, what are your expectations when it comes to this recovery? And, as that chart kind of illustrated, a lot of the upside could be because of a flattering comparison.
Yes, so we have similar views. We do think that the export and the import growth in April will stage a recovery compared to March, and probably slightly not as strong recovery for the exports fronts. But overall speaking, we still think that the export trend should be on a modest recovery trend, given that we are seeing pretty resilient U.S. economic growth, and we also expect the euro area growth to be picking up after last year's poor performance.
When it comes to, of course, front and center at the moment are these concerns over Chinese overcapacity. How is that expressed through the trade numbers, and what would you be watching out for?
So I think if you look at the volumes, for example, for the new energy exports, actually they are doing pretty well. But in the value terms, they are not as strong. And I think that's really reflecting the fact that because of China's over excess capacity problems, we are really seeing that the price effects have been a pretty significant drag. And that also tells you the problem of China's the strategy of cutting prices are really exerting a lot of deflationary pressures through the supply chain, and we are really seeing in the PPI numbers for China as well. And so as a result, we are not really surprised to see that there have been increasingly large number of countries complaining about China's excess capacity issues. So that's going to be a problem for the exports over the medium term. But at least as far as this year is concerned, we're still looking for a pretty solid export recovery trend for China.
And part of that overcapacity complaint also ties back to demand within China as well. What are you seeing among Chinese consumers at this point in time?
So I would say that the Chinese consumers definitely had a very weak recovery in 2023. And right now, probably we are starting to see some small recovery trend. I think if you look at the CNY, the holiday spending numbers, for example, and even the latest the national the Labor Day holiday spending, I think the services are still doing pretty well, but at the same time, if you look at the other items like goods spending, and even I think for the NEVs or more like autos in general, that you still really need to see the policy support coming through for us to see continued recovery for these for the auto sectors. So I would say that probably we're looking for some stronger recovery momentum in consumers compared to last year, but it will still be the pretty soft pace, and we're not really looking for the recovery momentum, like talking about retail sales of 8%. That's the pace that we've seen before the COVID, the years before the COVID, and I think that's unlikely for us to see that anytime soon.
Michelle, what I found really interesting in the travel data so far this year is that from the Lunar New Year, but also from Golden Week, is that you're seeing more people that are taking trips. So that's obviously a good signal. But it's the average spending per trip that is still weaker. But how much of this perhaps is just a new trend that's emerging within China? And is there even that expectation we should go back to 2019 levels?
I think it is pretty clear that there has been a shift in consumers' preference, that they value the experience, they value the quality of the goods, and there's also some disinflation or even deflation momentum going on. So if you look at the spending per visitor numbers, you look at the Golden Week holiday numbers, is still below the 2019 levels. So I think that's really telling you that the consumers, they are really having this cyclical backdrop that is still a bit weaker. And the structural shift also means that if you look at the value, the nominal numbers, they're not going to be recovering very strongly. So that's we have to understand both the cyclical and structural backdrop to these numbers.
Michelle, we've seen that real turnaround when it comes to sentiment, at least for equity investors, and some of that has been foreign investors too. To sustain that, what do you think needs to happen from a policy perspective?
So I think there are a lot of drivers that have been causing the recent rally in the Chinese markets. The first point is that there has been a severe correction since the second half of last year, so it's not really surprising to see a tactical recovery. And there have also been some supportive news coming from the April Politburo meeting, most prominently the message on the property policy. We sense that there's probably the beginning of a shift from the policymakers from the emphasizing on the three important projects, that is to support the building of the more rental housing or affordable housing, to destocking, which I think is actually pretty positive, because if we look at China's the economic slowdown right now, I think a lot of it is really driven by the house price decline, and that is really affecting the consumers' confidence and affecting the wealth effects. And if we really manage to see a house price stabilization, because some of the destocking efforts are working to put a floor on the house prices, I think we could be looking for some maybe house price stabilization at some point, and that also means that the kind of the house price correction as severe as like Japan or even in Hong Kong in 1997, maybe that's unlikely to repeat in China, and that also means that we may not be seeing the kind of a sustained deflationary momentum happening in China. So that's really about reducing the downside risk for China's housing downturn.
Yeah, Michelle, to that point, some people have made the argument that perhaps China could avoid that multi-year property malaise like we saw in Japan, like we saw in US following the subprime mortgage crisis. Do you see this shift now to destocking achieving perhaps that result?
Actually, I'm always of the view that China's housing problem is probably not as serious as what we have in Japan. And I think if you look at the housing structural demand, is now already, if you look at the level last year, is already below the kind of structural estimate based on the deteriorating demographics or slowing urbanization. And also the household debt for China, there's still room. It's not leverage up excessively, and the demographics is actually not deteriorating as quickly as Japan. So I think for China, the starting point is actually not as bad as Japan, and also there are a lot of policy room for from the Chinese policymakers to actually support the housing market. But I think even especially with this probably shift from the policymakers thinking, I think we could be talking about previously we're still thinking that there could be some downside risk for the top tier cities to see more house price correction, maybe for another 10 to 20%. But if we see we've seen relaxation of the purchase restrictions in the top tier cities, and we've also see faster mortgage interest rate cuts. So we could be talking about this reduced downside risk that maybe we could be looking for a stabilization for the house prices for next year.
That was Michelle Lam, the Greater China economist at Societe Generale. Thanks so much for your insights this morning and taking a look at how markets are faring so far this morning. Keeping a particular watch on what's happening in the bond space actually today, given we are seeing that fall coming across here, really just echoing the selling pressure in treasuries in the prior session that supported the dollar in turn. Equities looking a little bit mixed, pretty flat day on Wall Street. But we are just seeing that slight rise coming through in yields, mirroring again what I said we had for treasuries. We did actually have a more than $40 billion sale of 10-year bonds. That saw mild demand, US notes as well so far. Little changed at the outset of trading for today. But sticking with that bond, that credit space, actually Guggenheim Partners CIO Annie Walsh says having the Fed on extended pause is creating a positive environment for credit investments. She spoke with us from the Milken Institute Global Conference in Beverly Hills.
When we sat here last year, there were recessionary pressures in the system. Believe it or not, those recessionary pressures are still there. But there's been one big difference, and you talked about treasuries, and that's been the fiscal spending. It's really supported the economy in the U.S., even while the Fed has been tightening during the quantitative tightening process. And what you've seen is globally, other central banks tightening, but they didn't have the fiscal stimulus effect that we had, so they slowed down. Whereas we're still slowing, but at a slower trajectory than we would have anticipated last year when the Fed was very active in quantitative tightening.
How does that complicate what the Fed has to do? All right, fiscal spending, great growth. Jay Powell says, hey, guys, we're growing. But yet, some of that velocity creates inflationary pressures.
Absolutely. And what we've seen is that in quantitative tightening in the U.S., the balance sheet has been reduced from $9 trillion down to about $7.4 trillion. But when you think about the fact that deficit spending has been to the tune of about $2 trillion in that same time frame, it's really been almost perfectly offset by fiscal deficit spending at this point. And that is inflationary, and it makes the Fed's job harder. It's two forces working against each other.
Has it made your job easier, at least in terms of finding opportunities to invest?
Well, absolutely. Yeah. With a resilient economy, and by the way, usually, periods where the Fed is on pause, which they are, and we do not see a rate hike, we are not in that camp. That's a very good time for credit, for fixed income investments, particularly investment-grade fixed income, and also for risk generally.
I have to ask you, though, about the health of the market, particularly the Treasury market. Lisa Cook over at the Fed, she was just speaking a little while ago, talking about she had some concerns about Treasury market liquidity. And this has been a conversation that's come up before. I guess for you, does it matter? And B, if there is a liquidity issue, how severe is it right now?
Well, liquidity is a concern, but I really don't see it as a short-term issue. Right now, there's plenty of liquidity in the system. If we think perhaps more big picture, since quantitative tightening started globally, $5 trillion has come out of the system. But when you think of that in context of where we were pre-COVID and how much has come in since the COVID, quantitative easing that occurred and the stimulus, that was $12 trillion. That means there's still an extra $7 trillion out there that still has room to, move. We have a lot of flexibility.
Guggenheim Partners CIO Anne Walsh there speaking with our colleagues Karen Massa and Romaine Bostich. We have more ahead on Daybreak Asia. This is Bloomberg.
Well, Hong Kong is turning to oil-rich Saudi Arabia for new funds to help offset a growing list of challenges facing its stock market. The Saudi Tadawul Group and HKEX are co-hosting a conference today for Saudi firms to meet Asian investors. Our China show co-anchor Yvonne Mann is at the event and joins us now. And Yvonne, we've already seen, for instance, CSOP issuing an ETF that tracks Saudi stocks. I mean, this is just yet another signal of this growing connection we're seeing between the Middle East and between Hong Kong and Greater China.
That's right. And it's at the inaugural event of the Capital Markets Forum, Belle, as you mentioned, co-hosted by the Tadawul Group as well as Hong Kong Exchange. And the theme is powering connections. You've seen a very sort of warming of close ties between China and the Saudis of late here. Even the Hong Kong chief executive, John Lee, has made multiple trips to Saudi Arabia to try to at least lure some investors or even that Saudi Aramco second listing to this destination. So certainly there's a lot going on. The timing certainly is pretty opportune as well, just given the fact that Hong Kong has been dealing with this pretty depressed IPO market for the past 2 years. They're going to need new listings, and they definitely want some big names as well. And the Saudis themselves, are certainly businesses and the delegates that are here are looking for more of that foreign ownership of Saudi assets as well. So they're looking for to gain more of that exposure to an Asia investor base. So while this is all beneficial to Hong Kong, we're certainly going to ask about the opportunities, the IPO pipeline. Bonnie Chan, the new Hong Kong Exchange CEO, going to be joining us. And certainly we're going to talk a little bit more about some of the measures that we heard from the CSRC just last month to talk about encouraging firms to list here in the city. What does that exactly mean, and how big of a boost can that give the city here?
Yvonne, how can Hong Kong investors gain exposure at the moment to Saudi assets?
Yeah, so as Belle mentioned, right, so there is one ETF right now. This is the CSOP Saudi ETF that was launched back in November. And, that certainly is the first fund of its kind here in Asia where Hong Kong investors can gain exposure to Saudi assets. And $1 billion in assets was really what was promoted back in the day with the backing of the Saudi Arabia Sovereign Wealth Fund. Yes, so it was very promising. You take a look at how performance has been, though. This is where we're seeing volumes have come down. Bloomberg Intelligence is saying, I think they've only attracted about $20 million in funds so far. So we're asking the asset manager themselves, Ding Chen, about what is still needed to bring some more liquidity there.
Our China show co-anchor Yvonne Mann there at the Capital Markets Forum in Hong Kong getting underway today. Lots of great conversations. That is it for Daybreak Asia, though. The China show is next.